Good morning, everyone. Hope you all are safe and healthy. I, Ankan Paul, and joining me today is Mr. Yash Mehta. He is an MBA in Finance and CFA Level 2. He is also the founder of Finquity Right. To become a successful option trader, one must practice discipline, doing extensive research, identifying opportunities, setting up the right trade, forming and sticking to a strategy, setting up goals, and forming an exit strategy. They are all part of the discipline. So today Yash will be throwing light on the same, specifically on option selling and risk management. I would be handing over the webinar to Yash without further delay. However, we would be taking up the questions of the audience at the end of the webinar and we would be answering them at the end. Over to you, Yash.
Thank you, Ankan, for the introduction, and thank you, team, for giving me this opportunity. And also, I would like to thank all the participants who are giving their time for the presentation. So, I just want to clarify that is my voice audible or something needs to be done? You can type in the chat if my voice is audible, yes or no. Okay, so I think it is audible. So today we will be discussing about the systematic trading and managing the risk using option selling strategy. So we will be drilling down how the strategy is formed, what are the key components of the strategy, why are we doing this, and what is the returns that we have got in the backtesting result. And also we will include the return on time that we will spend, that we are going to spend in market for this. So this is completely an intraday strategy. So let's start with the strategy. So before starting, so this is about myself. So basically, I am Yash Mehta from Mumbai, and I had completed my MBA Finance from JBIMS and also BTech in Electronics Engineering from VJTI. Recently, I've cleared my CFA Level 2 and also I've cleared my NISM Series 8 and Series 15 exams. Also, I'm having an experience of over 7 years in trading and investing. Primarily, I am a positional trader, but I do option trading to generate regular active income from the market. Also, I'm a founder of Finquity, where we are continuously curating blogs and content related to stock market, IPO, companies, analysis, and everything. So this is brief about myself. So let's start with the today's session. So basically, what are options? So basically, options are financial derivatives that give buyers the right, but not the obligation to buy or sell an underlying asset. So the buyer will be getting the right only if the option is getting expired as an ATM or ITM contract, and the seller of the option will have to exercise it, and will have to give the underlying or take the underlying from the option buyer. So there are two types of option: the call options and put options. So this is basically the wide range of options. There can be a wide range of option strategies that can be designed for basically hedging income or speculation. So the investor use option to hedge their portfolio, whereas traders use option to generate income or speculate in the market. And there are many opportunities to profit with options. So traders should basically also check the risk which these options have while trading. And in a nutshell, if we want to say, then option is a leverage instrument where you are paying or you are spending some amount, but you are taking risk on the big amount. So that is how the leverage instrument works. So we will discuss what are the basically in market you might be having two views. One is bullish and one is bearish. So for a bullish view, you can take position like call option buy. So in this, as you can see on the chart, for call option buy, there is a limited risk, but the reward is unlimited. So call buyer win in this case if the market goes up, and there is unlimited profit potential as well. Also, if you are bullish, but then you can go ahead and short put option. The payoff is exactly reverse. You will be getting limited reward, but the risk is unlimited on the downside. So if market goes down, then the risk can be unlimited or it will be very big compared to the margin that you have taken. So these are the two strategies that basically an option buyer use if they are bullish. Now talking about bearish scenario, so you can basically go ahead and buy put option. where the risk is limited, as can be seen on the third chart, and the reward is unlimited if market crashes or go down. And if market goes against you, then the risk that you're taking on the position is very limited. Now, the last case is basically the call short, and in this, the reward is limited, but the risk that you are taking on the position is unlimited. So, if market goes up or hit upper circuit, then possibly the risk or the loss that you will incur will be very high in that case. But the reward is limited. So this is one of the bases that we are going to focus. And in upcoming study, we'll discuss about the strategies also. Now, another important component about options is the theta decay. So the theta decay will be basically high for an ATM option, as can be seen on the chart, and it is less for OTM option, and it is least for ITM option. And the reason it is lesser for ITM option is because the ITM option premium is having some intrinsic value and time value. So the theta time value is very less for those ITM options. That's why the time value of money in ITM case is very less. But for ATM option, the entire premium or the majority of the part of the premium is theta decay or the time value of money. So that's why the in ATM options the theta decay is very high. Now, how we defined ATM, OTM, and ITM. So basically, let's say the Nifty is at 16,290. Then 16,300, which is the nearest strike, will become an ATM strike for Nifty. And for call option, any strike below 16,300 will be ITM option, which is basically in the money. And any strike above 16,300 will be OTM option, which is out of the money. And for put option, any strike above 16,300 on the upside will be ITM, and any strike below 16,300 will be OTM strike. So this is how we defined ATM, ITM, and OTM. And this is all about the theta decay. And other part of the option grids we will not be covering because we don't use that much. So this is another important point for the strategy. So our strategy involved in the option selling. So why we choose option selling over option buying? So there are a few points. So let's consider the case when an option buyer will win. So the option buyer will win only when the trend is in their favor, and which means the call buyer will win if market is in momentum and it is in uptrend. Whereas put buyer will win if market is in momentum and it is in downtrend. So in this case, if we consider the three scenario that market has, one is uptrend, downtrend, third is the consolidation phase. So an option buyer will win when market goes in his favor. So out of three, only one case is possible. One case is favorable. So the probability of winning here is 1/3. Whereas for option selling, when will an option seller win? So when trend is not in their favor, which means that if a call seller has shorted call option, then the call seller will win if market is sideways or if it is going down. Whereas the put seller will win if market is in sideways or if it is going up. So here there are two cases in which an option seller is going to win. That's why the probability of winning is 2/3 in this case. So what instrument we will trade and what is the strategy? So we will be trading Nifty weekly options. And the second thing is it is a completely intraday strategy. So why we are choosing intraday is because to avoid overnight risk of big gap up or gap down or any events. That's why we are choosing intraday. And also in intraday, you can manage the position, you can exit the position if stop loss gets hit. So everything is under your control. That's why we are choosing intraday. Now we will be having a fixed stop loss as well for our trade. So all our trade, we will be giving our stop loss order as well along after a trade is getting executed. And majorly we will be using theta decay and trend on our side. And as such, there will be no target for our position. We will let our position either hit stop loss or we will exit our position before 3:20 p.m. or 3:10 p.m. So for intraday, our cutoff will be 3:10 p.m. or if the stop loss is getting hit. So this is all about the trading that the instruments and the trading description that we will be taking. Now, what market trend will favor us? So in a day, you can see there are multiple like there's uptrend, downtrend throughout the day. So these two cases will be very less favorable. So for an uptrend and for a downtrend, so basically, if you want to say we will be at market opens at 9:15 a.m. and around 9:15, 9:16 a.m. we will be shorting an ETM plus plus one and minus one call and put option, and we will be keeping a stop loss as well on both the trades. Then if market is in uptrend throughout the day, then a stop loss will be getting hit on call side. But for put side, we will be keeping our position active till it is like the market is trending or till the stop loss is getting hit. So for uptrend, we will be stop loss will be getting hit for call side, but on one side our position is active, which might give small profit or small loss. Similarly, for downtrend, the stop loss might get hit for a put option, but for a call option, the position will be open. In that case, we might be getting less profit, or we might be getting less profit in that case for downtrend case. So these two cases is very less favorable for us. Now, if we see the highly favorable case, then it is completely sideways market. So if market is trading in range throughout the day, then neither our stop loss will be getting a hit or our stop loss will not get hit till 3:30, 3:10 p.m. And we might be closing our position at that time with the maximum profit that we can get for the day. So this is a highly favorable case for us when market is completely sideways. Now, one more scenario that have been observed these days in market is basically the kangaroo market or the highly unfavorable, where market is very volatile. It moves up and down, like it is very volatile. So basically, in this case, what will happen is if market goes up in with the momentum, then our stop loss for call option will get hit. And after that, if it goes down or crashes in the day itself, then our stop loss for put will get hit. So in that case, both the stop loss will be getting hit, and we will be getting a higher loss for that particular day. So how to overcome this kind of situation is, let's say our stop loss for call option have got hit, and there is some premium that have gone melted in put options. So what we will do is, for the put option, we will trail our stop loss to the cost, and we will wait for the stop loss to get hit, or we will wait for like market to close the exit our position as well. So this is the modification that we have done for the system so that we don't get badly hit for the day when market is very much highly unfavorable for us. So we have to keep our loss in control as well. So this is about the market trend that can favor us, and we don't know what trend the market will be for the next day. So we will have to follow our system discipline with the discipline so that we don't end up with big loss in any scenario. So this is about the market trend, and now the benefit of using this strategy is basically the trader has to remain active for 5 minutes during the market opening and market closing. So as I said earlier, at around 9:15, 9:16 a.m., you have to punch in both the orders for call and put option, and simultaneously you have to put the stop loss order as well, so that and you can basically focus on other work or focus on other strategies or other trading, and then you have to just log in into your system at around 3 p.m. or 3:10 p.m. and just see if this if position are open or not. So let's say if a position is open and no stop loss have got hit, then you have to manually exit all your position by 3:10 p.m. And let's say if position is closed for one leg, then manually you will have to close position for the second leg. And if both the stop losses have got hit, then you have to close position for you don't have to close any position, so it will be automatically closed. So hardly you have to give 5 to 10 minutes throughout a day. And if we see market hours, then it is around 3 hours 15 minutes for the market, and out of which you are only spending 5 to 10 minutes, which is which is fractional in this case. Second thing will be the stop loss order will be there in our system, and if stop loss doesn't get hit, then manually you will have to close all the trade during the market closing. And this strategy is highly favorable for highly suitable for the part-time traders, and also full-time traders can use it to generate active returns with minimal effort. So I will also share the backtesting result and everything for this strategy. And talking about the return on the capital, but I will say that return on time that you are spending on this strategy is very high, because you are hardly giving a fractional amount of time during the market hours to generate the extra alpha on your capital. So this is the major benefit of this strategy. So the statistics and all the payoff is shared in the Excel file. So I will just open the Excel with. So just wanted to know that is my Excel visible? So you can just type yes, comment the Q&A. Okay. So basically, this is the Excel file, and the entire strategy has been backtested from uh, from 1st July 2022 around 10th June 2022. So which is roughly around 2 years for the strategy, and the entire thing is being followed. The entry price, exit price, stop loss, the profit and loss cumulative, total profit and loss, and also there are many things to look into this. So I've created this stats or summary sheet for the same. So the start date is basically 1st July 2020 and end date is 10th June 2022. So number of days is basically 709, which is roughly around 2 years. Uh, for this, we have got total number of trades as 944. And if we check the profitable trade, then it is 605. Whereas the number of trade in which we have lost is 339. So the accuracy is basically at 64% in this case. And if you have seen in the slide as well, we have discussed that the probability of winning for option seller is around 66% or two-thirds. So this number is close to that. The total profit that we have generated is around 1.16 lakh, and this we have arrived after subtracting the total profit by total losses that we have got. For this strategy, the capital that we are using is 1.5 lakhs, and the return on capital is 77.3%. The second thing is the CAGR that we are getting is 34%, which is very good for a trader. And we have not included the return on time factor because it is not we can't calculate it. But the CAGR itself is very good for a trader. Now, second thing is the expectancy. So the expectancy is around is 123 rupees, which means for every trade that we are taking, it is expected that we might we will be earning 123 rupees in that case. The maximum drawdown for this is basically 11.5 percentage, which is 17,320 rupees if we are using a capital of around 1.5 lakhs. Also, if you see the margin that that will be using for this strategy is 98 on 1 lakh, around 1 lakh. The extra margin that we are keeping is basically for the drawdown, and in case the drawdown exceed, then we can keep this margin, extra margin for that. So now talking about the status of the profitable trades. So the average profit for per trade is basically 1400, and maximum profit that we have got is 9500. And same for loss thing, the loss is around minus average loss is 2200, and maximum loss that we have got is basically 16,785. So this will be the scenario when, in case of any events where some event would have happened, like the elections or the RBI meet or anything. Now we have drilled down this backtesting result into the number on the weekdays basis. Like on Monday, we have got the loss of around 27,000. But for Tuesday, Wednesday, and Thursday, it is very favorable. Like we have got a decent profit. On Friday, the profit is very less, around 19,100. So here, the scenario will be the theta decay is very less for the Friday. But on Monday, like by looking at the statistics, you can basically think of avoiding the trades on Monday itself, and you can focus on the strategy on Tuesday, Wednesday, and Thursday and Friday. So you can modify the strategy like that as well after going through the result and everything. Now, so basically now talking about the capital. So we have started on 10th on 1st July, and it is ending on 10th June. So we have started with 150, 1.5 lakhs. And the final, the capital that we have got is at around 2.66 lakh in this case. So this is the ending capital of after considering all the trades. So this is how the strategies has worked and has created a decent alpha for us. So this is about the strategy and entire backtesting result, and you can check this out as well. So this is all about strategy, and like I'm open for any question and answer from the participants and from the team. So I will hand it over to Ankan now. So I will take Q&A from questions from the chat section itself. So which week is selected for trading? It is current week only. So we will be trading on the current week expiry say thing only, so not for next week. So this is the answer for Manoj Kalwani. Yeah, hi Raju. Yes, Raju, you can ask your question. So which call and put of same strike? So basically, let's say Manoj ji, I will answer the question. So I will just share a screen. Yeah. So what we will do is we will see the level at which market is opening at around 9:15 a.m. Let's say market had opened at around 15,000 or 16,100, 16,020. So what we will be doing is we will finding out the nearest ATM strike for this, which will be 16,000. And what we will be doing is for call option, we will be shorting 16,050, one strike away from ATM. And for put option, we will be shorting 15,950 put option, which is again one strike away from ATM. So what we will be doing is we will be taking one strike away from ATM option so that we can get maximum benefit of theta decay in that case. So this is how we will plan our trade, and whatever level 50 opens at 9:15 a.m., we will take the level, we will find out the ATM strike, and then we will be deciding the strike for call and put option. And it will be completely liquid selling. We will not do any hedge or anything. So this is the strategy. So what is the stop loss for Nifty options and Bank Nifty in terms of points? So anonymous, I think it is completely dependent on the strategy that you are trading. For the strategy that I have discussed, the stop loss will be 50%, like 1.5 times the premium which I'm getting after shorting it. So I will again go on the screen. So let's say I'm shorting a call and put option of 150. I'm shorting 150 rupees call option. Then my stop loss will be 1.5 times of this entry price. And for put option, again, it will be 1.5 times of this entry price. So this will be my stop loss for the strategy. And so this is how I define the points, the stop loss in terms of point for Nifty. And regarding Bank Nifty, I don't do Bank Nifty options. I trade only in Nifty. So I can't comment for Bank Nifty. But during the day, the EMDK is insufficient to cover another, rather carry forward gives a higher theta decay. So we are not using this strategy for positional, like we will carry forward or anything. It is completely intraday strategy. And we don't know what will happen the next day. So that's why we are not taking that uncertainty risk in this trading. So we are basically taking ATM near ATM strike straddle because the theta decay in that strike or in the straddle is very high, and that's why we are taking ATM short straddle, or we can call short strangle as well. And we don't consider India weeks in that case. But in, let's say if there is any event in that day, then it's better to avoid reading the strategy or trade it with the strict stop loss. But yeah, we will not consider any India Greeks or any other option Greeks apart from, like, yeah, we will not consider any Greeks in that case. I hope I answered your question, Raju. So Manoji, if market moves to 16,175, before that only a stop loss for call option will get hit. So if I again share the screen, yeah. So if I again share the screen, a stop loss for call option is 225, and it won't wait for it will be getting hit in that case. So and the put option from 160 might trade at around 100 rupees. So we might get profit of around 60 in this case, and we might lose around minus 75 in this case. So minus 75 plus 60. So I have said that if market is trending, then it is very less favorable for us, because we might it will be a case where we will not lose big amount, or we will not earn big amount in that case. So if you see here, loss is 15 rupees only. So this case, if market is trending upward, then or trending downward, then it will be highly that will be very less favorable for us. So this is the final conclusion from the slide as well. So accepting small losses is fine, but you should like control the big losses also. You should avoid that. So that is the main motto. Yesterday's, yeah, Rajuji, but Raju, we will not focus on VIX or anything. Even if the VIX shot up, the premium will shot up, but we don't know when will it get shot up. So we can't stop our trade on basis on the if VIX shot up or not. We are following the complete setup. So we don't consider the VIX and anything, and it is intraday only. So the majority loss that will be happening is our stop loss might get hit in that case. So that is perfectly fine. But if you consider all this scenario, then you won't be able to take a position in that case. It will be too much overwhelming for us. That's why we are not considering any other option Greeks and including VIX. I think I have answered all the questions. Anyone from the team who can coordinate right now? Ankan or Snehal?
Sure. Mr. Mehta, just give me 1 second here. I'm just looking if there are any other questions, or we can just go ahead and end the seminar. Okay, Mr. Raju, you will be getting the recording sent from Edelweiss only. And I believe this was a very informative webinar. Thank you so much, Mr. Mehta, for giving the time, and thank you all the participants for being on there. And we can go ahead and end the webinar now. Thank you.
Thank you, everyone.